Croc stock is one that has, without a doubt, shocked me as an investor. Just year to date, which by the way, we're only about 2 weeks into the trading year, this company is already up almost 20%. If you go to last 6 months, this company is up 134%. And when I initially invested in this company, I initially bought my shares at $76 a share, $15,200 invested, and my current position is worth $25,000. And I'm going to talk in this video exactly why I plan on selling it, and the company's done great, don't get me wrong. The company's been growing, their Hey Dude acquisition has been doing wonderful, and overall I think this was a smart move on the company. They're paying down their debt, they're growing their revenue, they're doing everything that you want to see in a traditional business. However, I think now is the time that I'm likely going to be selling out. Going back here to my portfolio, you can see that I have a covered call, which is right here, set for March 17th of 2023, about 2 months of the time of me coming out with this video, set at the exact share price that we trade at today, in the 125 range. If the stock is still 125 or higher, I will be selling my position at that price, and in the meantime I'll get paid to wait, about $3,000 or so. But this is one that has done very well because of the explosive revenue coming from the Hey Dude acquisition in the most recent quarter, growing the business's revenue 57% due to the acquisition that they just made. Now I want to talk in this video what I think the company is going to look like moving forward, what I plan to do, and why I intend on selling, and what price would it have to go to for me to buy back into the company. This company far exceeded my expectations, and it's nice to finally have a winner despite being in a recession and pretty much every other stock going down. So without further ado, let's go ahead and get started, and we'll start by looking at the most recent quarter in terms of its revenue and profitability. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, welcome back, and let's go ahead and start by looking at the most recent profitability that is up 31%. Now here's the big caveat. The balance sheet now looks awful. Ever since this acquisition closed, they've raised billions of dollars in debt to try to buy out this new company, and they did just that. And if you want to see the details behind this, you can pause the video right here. I'll give you a second to look at it. Long story short, they paid $2.5 billion to buy out that shoe brand Hey Dude, and this is a company that is growing significantly faster than the traditional Crocs brand. Now they had to raise a lot of debt to do so. They're currently paying off about $100 million or so a quarter, and they're committed to paying back that balance sheet as aggressively as possible, and I expect this to continue dropping. That's one of the big risks of owning this company, and I think that this will go by the wayside very soon. Furthermore, they paused share buybacks to pay down that debt over time, and you can see that started to increase over the last couple of quarters as it's generally trended up a couple million each quarter due to the Hey Dude acquisition. However, on the flip side, profitability and revenue has skyrocketed. Profits in the last quarter is up 31% year over year. Revenue is up an even higher 57% year over year versus the last quarter versus the one before in 2021. Now this company is reaching almost $1 billion a quarter, and it's broken down specifically by these segments. About 985 comes from the total company, and 716 of that came from Crocs itself, and then Hey Dude made up 269 of that. And Crocs is growing currently at 14% or 20% on a constant currency basis, and then Hey Dude is growing at an astounding 87% year over year, and we'll get updates on this very soon. Now, constant currency is obviously taking out foreign exchange headwinds, but long story short, this company would have done significantly better in terms of its revenue and profitability growth if we didn't have foreign exchange headwinds. I expect this to go by the wayside very soon, and this headwind will likely become a tailwind moving into 2023 and especially 2024 in my opinion, but regardless, it's something to note. Now, Hey Dude has exceeded pretty much all expectations. I think it's exceeded the company company's expectation based on what you can read right here. Pause the video if you want to read over this, and it's also exceeded mine. I love them, and funny enough, I used to have one pair of Hey Dudes, and thanks to Christmas gifts, I actually received 3 on Christmas, as crazy as it is, and I now have 4 pairs of the shoes, and I currently don't own any Crocs. But Hey Dude, I've been seeing them blow up everywhere at the tech company I work at. There are people all over the place, men and women, that are buying these shoes like crazy, and this is a company that overall has exceeded my expectations. It still trades at a low valuation in the PE ratio of about an 8 to 12 range, depending if you're looking at trailing 12-month or 8 forward PE ratio. And this is one that has mostly led my portfolio into success by a wide margin, mostly due to this company. Now, year to date, the first 11 days of the year, as of January 11, 2023, which by the way, this is brand new in 2023. This brokerage now shows daily updates to my performance. So now I want to show it in every single video, which will be awesome, rather than having to wait till every single month. But long story short, I have 16.88% positive performance in the first 11 days of the year, and it is crushing the market. It's only 11 days. We got another 300 and change to go, so this could very well change on a dime. But a big part of it is coming from Crocs, which has been one of my best performers in a short time period. I bought my hundreds of shares in September and October of 2022, just 4 and 3 months ago. That's not very long at all, and to hold a company that long, you would typically expect little to no returns. Many of these companies I've held, like Salesforce for example, I bought my initial shares a long time ago. The first shares I bought were back in April of 2022, almost a full year ago, and those shares I bought are down 30%. This has been one of my worst performers in a long time. However, Crocs, we've owned just a couple months, and the overall position is up 67%, and that's why I'm planning on selling the company. Simply put, there are better positions that I can put the money into. Crocs is a decent company, and it's come up a lot in share price, and frankly, there are many other positions that I can reinvest back into. Because like the companies that you were looking at on the list that are down a lot, if you look how these companies have done over the last couple of years, these have gone to the toilet. Amazon is trading at record low prices. Salesforce is trading at record low prices. Google are trading at record low prices. And another company that I'm currently keeping on my watch list, by the way, stay tuned for this because I'm probably going to be making a video for it, is CrowdStrike, which is currently trading at, you guessed it, record low prices. Previously at a high of 300, today trades around like 97. So this is interesting because this company went up for a unique reason due to its acquisition. It had forced explosive revenue, and it's much different of a company than traditional investments where I'm focused on subscription revenue businesses, tech companies, and this one just sells boring old tennis shoes. However, it's done great for me. It's one that is going to be one of my best performers in that time period. Honestly, it's so rare to see a company go up 67% in just a couple months, but this is where I'm at. It'll be one of my biggest winners probably throughout the last year. And yeah, that's pretty much it. I intend to sell out of it very soon. If this company is below 125 at the end of March when this contract expires, I might sell another contract just to generate some more cash to hold it in the meantime. And I think this company could keep running, but now's the time to walk away from the table and put money in other investments, in my opinion, because I think, frankly, it's time to walk away from the table when you're up. Thank you guys so much for watching. Check out MooMoo down below if you haven't already. And thank you guys for watching all the way to the end. Y'all have a good one, and I'll catch you guys next time.